Question number 6. Pay attention. 5 is remaining or done? 5 is also remaining. Now then we take up question number 5. Look at question number 5, page 62. On 31/12/2005, the balance sheet of a limited company reveals the following position. Now, see at the end what is asked. Which methods are asked at the end? Compute the value of company's shares by net assets method. Net assets method means intrinsic value of shares, and also the yield value method, which is based on dividend as well as earnings. Means we will find it from the point of dividend also and from the point of earnings also. 3 methods are to be applied here. Okay. First, let us see from net assets methods point of view. Will we take issued capital? Same? No. Sum of reserves? No. Raj profit and loss account? No. So the 5% debentures? Yes. Tick on that. Then urban current liabilities? Tick on that. Nisha fixed assets? Sharps current assets? Yes. Put tick on fixed assets, put tick on current assets. Am I goodwill? Yes, tick on that. In net assets point of view, all assets are taken into consideration except non-current assets, other non-current assets. On December 31st, the fixed assets were independently valued at 3,50,000. So we'll take fixed assets, but we'll take the value as 3,50,000. Goodwill at 50,000. So again, goodwill we will include, but instead of 40,000, we'll include. And we don't have to find the value of goodwill here. Value of goodwill is directly. The net profit for the 3 years were 2003, 2004, 2005. 3 profits are given to you. In net asset method, will net profits be of any use? In net assets method, no. It will be used in yield method. Because in yield method, how do you find profits available for equity shareholders? Profits after tax. That will take average of 3 years. Okay, in yield method, these profits will be taken into consideration. Did you understand this? Of which 20% was placed under reserve. So we will minus that transfer to reserves. This proportion being considered reasonable in the industry in which the company is engaged, and where? What do you mean by fair investment return will be taken at 10%? Normal rate of return is 10%. Compute the value of company's equity shares by net asset method, yield method based on dividend as well as. First we do it by net asset. So by net asset method, Raj, how will we start? Where is closing capital employed? Closing capital employed, we will start when you first find the value of goodwill. Your goodwill is not asked, okay, directly net asset method is asked. Agam, fair value of trade assets. We are doing valuation of shares, fair value of all assets. Yes, Agam, further. Fixed assets, 3,50,000 is the value, what will it take? Current assets, 2 lakhs itself because no value is given. Goodwill 50,000 is given in the paragraph, so we'll take 50,000. 6 lakhs is the total fair value of assets less fair value of liabilities. Yes, what will include that? 5% debentures, 1 lakh. Current liabilities, 1,30,000. So 2,30,000 if you minus, will get. What do you call that as? Net assets, but there are no preference shares, so this itself will be called as net assets available for equity shareholders. Did you understand this? Then number of eliminations. Therefore, intrinsic value of shares is equal to net assets available for equity shareholders divided by number of equity shares. It's further 3,70,000 we got net assets available for equity shareholders divided by number of equity shares. Can you see 4 lakhs share capital is there? Face value is 10, so 4 lakhs divided by 10 it would be 40,000. Okay. 9.25. So everyone is clear with this? First method is that there is net assets and return. Now, what is the second method? First, we do it by dividend yield method. Now, for dividend yield method, first we require profits available for dividend to equity shareholders. Everyone has completed until here. First, what we will do is we'll find average profits of 3 years. Then we will do minus transfer to reserves. And minus preference dividend is not there. Do we have preference share capital?
No.
So preference dividend is not there. Okay, first we do average of 3 years profit. So years, whose mobile is this? Net profits. Now, first of all, years 2003, 4 and 5. And net profits 51,600, 52,000, 51,650, 1,55,250. Okay. So we can find the average profits after tax. Average profit after tax is equal to 155,250 divided by 3, 51,750. Any confusions in this? Then what do we have to minus to get profits available for dividend to equity shareholders? Minus transfer to reserves. See what is given in the question. How much do we have to transfer to reserves? 20%. So 51,750 into 20% we will transfer to reserves. 10,350. Do we have any preference dividend? Otherwise we would have subtracted preference dividend also, but there is no preference share capital. So 41,400 is profits available for dividend to equity shareholders. Okay, profits available for dividend to equity shareholders. Now, after that, what is the first step we have to find? Expected rate of dividend. Expected rate of dividend is equal to profits available for dividend to equity shareholders divided by paid up equity share capital into 100. Now what are profits available for dividend to equity shareholders? 41,400 divided by what is paid up equity share capital? 4 lakhs. What is paid up equity share capital? 4 lakhs into 100. 10.35%. Understood this, everyone? Now, value of share, what is the formula? Value of share is equal to expected rate of dividend divided by normal rate of dividend. Here you are given with normal rate of return into paid up value of shares. Means, what is the expected rate of dividend? 10.35 divided by what is the normal rate of return given? 10 into what is the paid up value of shares? 10 rupees. So rupees 10.35 is the value of shares. Okay, this is by which method? Dividend yield method. Now third option is earnings yield method. Now this is the new one we have to understand. Others we practiced until yesterday. Anyone still writing up till here, raise your hand. Completed everyone? Now earnings yield method. Here how do you have to find the expected rate of return? Profits after tax but before interest. So first we have to make that calculations. Divided by gross capital employed. So we have to make that calculation also. Means two workings are required. First profits after tax but before interest and gross capital employed. Then we can apply the two steps. Okay. Now how do we find profits after tax but before interest? Profit before interest. But we don't have profit before interest and tax given to us. Minus interest. We get profit before tax. That also we don't have in the question. Minus tax, we get profit. We directly have profit after tax available. We have to directly start this calculation with profit after tax. Then what do we have to add? Interest. Now in case if we have 5% debentures of 1 lakh, then what will be the interest burden of the company? 1 lakh into 5%? 5,000. So only two steps we get profit after tax but before interest. We directly start with profit after tax. In that we add the amount of interest. Any confusion in this? So write down average profits after tax. We already obtained as 51,750. In that we have to add interest. That is 5,000. 1 lakh into 5%. 1 lakh of debentures into 5% of interest. So 5,000. 56,750 is profits after tax but before interest. Any doubt up till here? Now further, what was the denominator? Average profit after tax but before interest divided by gross capital. Now How do you find gross capital employed? We always do by indirect method only throughout both the chapters. So, fair value of all assets. Have we already done that or not?
Yes.
So no need to do that again. Minus fair value of only means from 6 lakhs we have to minus only. We don't have to minus. So you can alternatively do 370 plus 1 lakh.
470.
Or you can do 6 lakhs minus 130. Okay. Fair value of all assets minus only current liabilities. Or we have done fair value of all assets minus fair value of all liabilities. So which we did not have to subtract? Debentures. You cancel it, you add it back. Means from 3,70,000, even if you add 1,70,000, you will get the same answer. Either you do 6 lakhs minus 130, 470, or you do 370 plus 1 lakhs, both the ways 4,70,000. Any confusion in this? All up with it? So, add on fair value of all assets we have already done as 6 lakhs minus fair value of current liabilities, that is only 1,30,000. So you will get 4,70,000 as gross capital employed. Or right, both the ways. Reason in MCQ any situation can come across. If they directly give you the net assets available for equity shareholders, then you have to add back the long-term borrowings. So alternatively, we can do net assets, which are 3,70,000 plus long-term borrowing debentures. We have to add back 5% debentures, which we did not have to subtract in net assets. 1 lakh. Here also you get 4,70,000 as gross capital employed. Did everyone understand this? So now we can apply the 2 steps. First is expected rate of earnings and then value of shares. So, expected rate of earnings is equal to, now here the formula will be profits after tax but before interest divided by gross capital employed multiplied by 100. Now what are profits after tax but before interest? We got 56,750. Upon gross capital employed we got 4,70,000 into 100, 12.07%. Any doubts up till here? And then value of same formula, expected rate of earnings divided by normal rate of return into paid up value of shares. Therefore, value of shares is equal to expected rate of earnings divided by normal rate of return into paid up value of shares. So, expected rate of earnings 12.07 divided by 10 into 10, that is rupees 12.07. So, everyone else okay with this method also? Any doubts on it? Now we take up the last method, fair value method. Okay. 2 methods we have done, net asset method and in fact 4 methods are there. Did I make you write 3 methods? Insert 4th one also, price earning ratio method. If I made you write 3 methods, then 4th method is also there, price earning ratio method. Price earning ratio method. Okay. Anyway, we take up the 3rd method today, this fair value method. This in fact I explained in the beginning of the chapter itself, nothing new to understand here. What is fair value method? I explained in the beginning. Fair value. Exactly. We have to take average of the other 2 methods. Means in this question, if fair value method was asked, then it would have been intrinsic value of shares, that is 9.25 plus value of shares by yield method 10.35 divided by 2. If you take it earnings basis, then 9.25 plus 12.07 divided by 2. So what is the fair value of shares? Intrinsic value of shares plus yield value of shares divided by 2. It is the average of earlier 2 methods. So write down. Fair value of shares is equal to intrinsic value of shares plus yield value of shares divided by, so no new point to be understood over here, just the formula. Anyone having any doubts on this? Now see, I discuss question 6 and you do on your own, because same thing what we did here we have to do, only one extra step at the end. Just now we did intrinsic value of shares as well as yield value of shares. That is what you are supposed to do. So I am discussing question 6 and you are all trying on your own. The balance sheet of Diamond Limited as on 31/12/01 is as follows. Equity share capital rupees 100. See at the end what is asked. Intrinsic value method, yield value method, as well as fair value method. So fair value means after intrinsic and yield value just we have to do the average. Okay. Just 1 minute. Yes, dear attendant. First we see from intrinsic value point of view. Will you take equity share capital? Yes or no? No. General reserve? No. Profit and loss? No. Sundry creditors? Tick on that. Land and building? Land and building, plant and machinery, patents, trademarks, stock, debtors, bank balance, all tick. Preliminary expense? No. The expert valuer valued land and building 2,40,000. So instead of 1,10,000, you will take 2,40,000 in fair value of all assets. Goodwill? Goodwill is not given in the above assets, but you have to take it. So here you will directly include goodwill of 1 lakh. Plant and machinery 120. Depreciation is charged at 10% on plant and machinery and 15% on buildings. Now, mark this important line. It will not have any effect over here. It will have effect in adjusted profits, means average profits. But you have to do this, understand it. How much is land and building in balance sheet? And now what is its value? 2,40,000. Means we should now calculate 15% depreciation of land and building on 2,40,000. What is that? 2,40,000 is 15%. 36,000. Whereas in the books we have calculated 1,10,000 is 15%. 16,500. Now in the books what we have provided? 16,500. But now as per the new value it should be 36,000. How much more depreciation you have to provide? 19,500. Additional depreciation you will minus from average profits. From the average profits, you will minus additional depreciation of land and building 19,500. Same way. What is plant and machinery's value in balance sheet? 1,30,000. What will be 10% of that? 13,000. This is already provided in the books. Now what is its value in the paragraph? So 1,20,000 is 10%. What it should be? 12,000. But we have already provided 13,000. So now what will you do? You'll add 1,000. You'll cancel it. So additional depreciation of land and building you will minus. What amount? 19,500. And excess depreciation of plant and machinery you will add 1,000. I repeat it one more time. If anyone is not clear, then raise your hands. In balance sheet, land and building is 1,10,000. 1,10,000 is 15%. 16,500 is already provided in the books. The fair value is 2,40,000. 2,40,000 is 15% depreciation should be 36,000. But we have provided only 16,500. So now if you provide additional depreciation of 19,500, 36,000 minus 16,500, profits will decrease. We will minus additional depreciation of land and building 19,500. But plant and machinery opposite. In balance sheet the value is 1,30,000. Rate is 10%. So 1,30,000 is 10%. We have already provided 13,000 and debited to P&L account. But as per the new value 1,20,000, it should be 1,20,000, 10% only 12,000. We have provided more. How much more we have debited in P&L account? 1,000. If you reverse it, the profit will increase. So in profits we will add excess depreciation of plant and machinery 1,000. Did you understand this? Out of the total debtors, it is found that debtors of 8,000 are bad. Now, first of all, here, when you take debtors, you will take 88,000 minus 8,000? 80,000. Secondly, here you will minus bad debts from average profits. Not from average profits. Bad debts you will minus only from 2001's profit. Bad debts will minus only from the profits of 2001 because that will affect current balance sheet only. So once again, effect of bad debts, here you will take debtors, 88 minus 8, 80,000. And when you do the average, then in 2001 profits, you will minus this bad debts of 8,000. Depreciation, do it from average because it is going to affect future. Okay, expert value as value means it is going to affect future. But bad debts you minus only from 2001. Any confusion in this? Now the profits of the company are given for 3 years, so this will help you in yield method. First, you'll take 2099's profit 90,000, 2000's profit 80,000, but 2001's profit 1,06,000 minus bad debts 8,000, 98,000. Then do the average. Is everyone clear with it? Like this to do adjusted profits that way. After doing the average, then you minus additional depreciation of land and building and plus excess depreciation of plant and machinery. You'll get average profits after tax. And then from that, let's see what is given. The company follows the practice of transferring 25% to general reserve. From that, you'll start separate transfer to reserves 25% and you'll get these profits available for dividend. Similar type of companies earn 10% of value of shares, that is normal rate of return. Now calculate the value of shares and their intrinsic value, yield value and fair value. And in yield value, have they specified dividend or earnings? What did I make you write in the notes yesterday? If nothing is mentioned, always use dividend yield. So earnings yield is not to be done here. You'll do intrinsic value of shares, you'll do dividend value of shares, and then you'll apply this fair value of shares from the intrinsic value plus yield value divided by. I'll do it on the board at the end. So tomorrow we'll complete the chapter. Only price earning ratio is method is remaining. Who have completed